Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. Did you know that it's actually been 3 days since I last posted a video? And when you paid off your debt, it's actually very hard to be focused and disciplined. Very lazy nowadays. Well, lazy compared to what I normally do. In fact, I have over 1,000 videos on this channel. I can't even believe it. And also, if you don't know who I am, if you look at the screen in front of you, I paid off a mortgage in 2 years and 9 months. Yeah, I can't even believe it either. Sometimes I just blurt it out loud in real life, and I think people act like they didn't hear me. You ever get that? When you paid off a mortgage in 2 years and 9 months, and then people act like they didn't hear you? Oh, right, you probably didn't because it's not relatable. Smirk. Okay. Yeah, I mean, people may act like you're crazy. Sometimes people come to this channel like, it's not relatable, what you're doing. I never said it was. I'm just acting a little bit crazy because that's what happens when you pay off your mortgage in 2 years and 9 months. It's just an opportunity, to boost your ego. And by the way, did I tell you I paid off my mortgage in 2 years and 9 months? Oh, I didn't? Let me tell you again. I paid off my mortgage in 2 years and 9 months. All right, so let's go ahead and get started. What's velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. So first step to doing velocity banking is creating a budget. So we have the income here, $8,700. We pay our debts, right? Our expenses, and then the leftover we put in our savings. But oh no, we have too much debt, and our savings is negative $185. That's no bueno, right? And so if you take a look at our expense breakdown, you list every single debt that you have. We have 8 credit cards, a car loan, a student loan, and a mortgage, right? And look at this very cheap student loan, 25,000. Must have went to community college, right? And then we got a pretty cheap mortgage, must have bought in 2020. And then we have our general expenses, which is $2,500 a month. So we assume that our general expenses, that's not debt, is always going to stay there. But we're going to try to get rid of our debt, okay, with the help of something called a line of credit. So when we do velocity banking, same income, same expenses, but we just redirect the flow of money. And the first step to doing that is actually not saving it. So you see this, how it's negative $185. We're going to make this into zero. Okay, let me zoom in on there. And so if you take a look at my checking account, right, it's zero. Money comes in, then I just withdraw the money out and pay something called a line of credit. So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So this is my home equity line of credit at $280,000. But unfortunately, I don't have access to this. Why? Well, actually, maybe it is fortunately because I have a new home equity line of credit at $373,500, right? And then I have tons of lines of credit, personal credit cards, business credit cards. A credit card is a form of line of credit, just a little bit more restrictive than a home equity line of credit. And then I have up to $697,000 in limits, right? And maybe in a year or so, it'll be a million. Now, here's a secret to getting credit. Okay, banks don't lend money to people who need it, and if you understand and internalize that, you'll know the best time to get credit. Because if you try to get money when you need it, you know what you're seen as. This is the word starts with a giant R. You're seen as a big risk. Okay, it's like this person's very risky. We don't want to lend them a negative $185 because once upon a time you made good money and the bank saw that and you didn't need it and they're like, all right, let's give this person some debt. And then once the person got some debt, once you got some debt, then it's like, uh-oh, I need money. And then the bank looks at you like, nope, thanks. This person needs money. Big risk, right? So that's how you get a line of credit is don't be a big risk, right? But let's assume that we have access to $170,000 free and clear. And the reason that we assume that is because what if you had known this strategy before you got here, right? Well, let's figure that out and see what happens. So what we're going to do is 5, 18, 15, 27, 37, 35, 18. And so what I'm doing is I'm summing up the balances of the credit cards that we have. Let me go ahead and sum this up. And that's $145,000. in credit card debt, right? So what we're gonna do is just shift that into our $170,000 home equity line of credit, okay? And then guess what happens here, okay? They all go to zero. So this is 0, 0, 0, 0, 0, 0, 0, 0. And then look at this. We literally went from negative $185 to $4,591.82 of cash flow. How do we go from here to here, even though the income is the same? I don't know. But I've done this presentation so many times that I just know it from the back of my hand, right? I don't know. Maybe I'm pulling a trick. Anyways, all right. So now the final step is $8,700. You put that into the line of credit as an overpayment, take your expenses out, and then your cash flow is the number of how much it will reduce, right? Your line of credit. So it's like your quote debt destroyer number. Anyway, so let's go ahead and do this. And I'm going to go ahead at G2 plus H2 minus 4591.82. So what are we doing? To get the next month's balance, we take the previous month's balance and interest minus the cash flow. And then what we do is take the average daily balance, all right? Average, multiply by the interest rate, and then you divide by 12 to get the monthly interest, and then you just copy and paste. Look at that. How do we go from 145 to 125 in a couple of months when we start at negative $185 in savings? I don't know. But if you just do this enough and memorize the formulas like I have, then it's relatively easy. And then you'll pretend to know what I'm doing just like I do here. Yeah, I don't really know what I'm doing. I'm just kidding. Maybe I am not. All right. So 36 months since this is all paid off, right? And so we just write our milestones here. 36 months to pay off, about 3 years, 145K credit card debt. Wow, that was really easy. Next, we got 3 loans: car loan, student loan, mortgage. And then I'm just going to put 36 months in our loan calculator. All right. And then what we do is we go here and then we just kind of shift debts around to the line of credit using something called the cash flow index. So I'm going to go ahead and move this car loan that's now at $8,000. And I'm not going to explain the cash flow index, a little bit too lazy today, but look it up on Google if you want a better explanation. Basically, a ranking system of the debt paid off, how you pay off debt, get more bang for your buck with terms of cash flow. So let's go ahead and move this 8 grand. So it's going to be plus 8663.51, 663. And then what we're going to do is this is going to be zero, $382. And then now our cash flow is almost 5 grand. All right, so let's go ahead and do this right here. All right, so increase our cash flow. So this is going to be 4973.84. All right, so now I'm going to increase this, right? So let's go ahead and do that. And then this is going to be how many months? 38 months until it's all paid off. 38 months. 38 months. All right. All right, so 38 months. We paid off 165K of debt. 165K. And then now we're into student loan and mortgage. So at 38 months, so this is zero. Our student loan, 38, 18,000. And we'll move this to the line of credit. I normally wouldn't do it with the longer term loans, especially if there's an interest rate difference, but I'll make an exception for this student loan because we should be able to get rid of it relatively quickly. I move the student loan right here. So this is going to be 18633.2. And then now let me go ahead and increase that cash flow. So this is going to be 0. And then what's our cash flow now? It's more than 5,000. 5,251. All right, let's go ahead and do it. All right, so you could do this right here. All right, so now this is going to be 5251.39. Okay. Bam, 41 months is paid off. 41 months. Okay, so now we're going to go ahead and do this right here, and then we'll do it right 41 months. Pay off 165 plus 25 is 190K. And then now let's do the 30-year mortgage. So at 41 months, what's the balance of the 30-year mortgage? Not 4 months, 41, 208. So luckily I got this velocity banking calculator right here. So I just got to plug and play most of it, although I don't know if this is correct. So let me go ahead and put in the income and the expenses. So what's our income? It is 8700, 8700, and then our expenses is 5251.39. No, our expenses is 2500. My bad. So 2500. And then what's the current balance of the mortgage? So we go right here at 208,351.66. 208,351. So 208,351.66. And then this line of credit information, if you're going to use a line of credit to pay off at this point, because I feel like, no matter what you do, if you do direct extra payments or a line of credit, honestly, it's not going to matter. But the most important thing that you should understand is if there's an interest rate difference with your 30-year mortgage and the line of credit, okay, 3 and 8, do you really want to move the whole thing into line of credit? Because take a look at this, 28 grand of interest. Yet, if I use a 30% credit card, okay, and just pay this off in $9,000 chunks, this pays off fast. I don't know if it's faster, but it's less, 14 grand than my what am I even talking? I lost my train of thought. Then my that's what happens when you get a text message out of the blue. 30% is actually less than 8% line of credit when you move the whole thing. Isn't that crazy? But if you do small chunks, look at that, 10 grand of interest, 3 years. So that's how long it'll take. Almost as impressive as 2 years and 9 months. Almost. This is why nobody will believe you. Oh, do I have Airbnb on here? Interesting. Why do I have that? Okay. Almost as impressive as 2 years and 9 months. But when you tell other people, hey, I paid off in 2-year mortgage in 2 years and 9 months, they're gonna act like you crazy. You crazy. Okay, so 3 years. All right. So let's go ahead and do this. And then I'm going to put a 0 here. And then 41 divided by 12 plus 3. That's 6.42 years. For 2 years. And we are debt free. Okay, debt free. Airbnb, what's going on there? All right. All right, well, that's it for today, folks. Sorry, I gotta do some stuff. That's why I haven't been posting. I'm actually working a little bit now. I'm getting off my butt. They say that if you work a little bit, you won't be a fat slob like me. Right? Really fat slob. No. Yeah. Actually, I'm not that much of a slob. I'm not Jabba the Hutt, but I think I'm going to get there. So I got to be a little bit active and stop posting YouTube videos. No, I'm just kidding. I know you all love me. I know you all love me. You want me to post more videos because I'm your velocity banking cult leader. Yep. No, I'm just kidding. All right. All right. So, well, that's it for today, folks. Watch me get canceled because I don't think we can use the term fat slob anymore nowadays. Actually, can we use that? Let me ask Google. Okay, let me ask Google. And I don't want to ask ChatGPT today. Will the term fat slob get me canceled? Potentially. Interesting. Even if I tell myself I'm a fat slob, that's no bueno. Anyways, okay, that's it for today, folks. This is Karina Lanta Mentorship. Watch me get canceled just because that's the culture we live in nowadays. All right, have a great day, and I'll see you on the next video.